2 months to complete. Okay, maybe after the next round of software application completed, we would switch back to this knowledge series about a technical analysis again. Okay, so today we are going to learn about indicators, application of indicators. Contents for today, 3 parts. The first part, I will teach you how to avoid the trap of indicators. Okay, the second part, we will talk about the key to indicator applications. The third part, I will talk about KDJ as an example, how to apply, to show you how to apply indicators in the proper way. Actually, KDJ is not the key point. The key point is you by learning how to apply KDJ, you can really master how to apply any indicator in future. Just taking KDJ as an example, because you know, for Homely software, we got so many special Homely indicators which are far more, let's say, powerful than KDJ. Actually, we don't really necessarily need to apply KDJ in our real tradings. But what's the point of talking about KDJ application in this session? Yeah, the purpose is to show you how to apply an indicator in the proper way. Any indicator, actually, you apply any indicator, you should abide by some principles. Okay. So before we talk about the contents, maybe we still need to look at the market performance a bit, the global market outlook for US market, for our local Singapore, Malaysia, and Hong Kong. These markets, our members are trading the most, right? Okay, so let me switch to the software to check the market performance. Okay, so now you can see the software, right? Okay, so firstly, we check the US market because US market has the very big influence on other markets, right? So whichever market you are trading, you have to check the US first, right? Okay, so US market, NASDAQ, you remember previously I have mentioned about the divergence, the bearish divergence for NASDAQ and also for the other 2 indexes. Later we also will check. And for NASDAQ first, you can see very clearly this is the previous high and this is the current, not yet sure this is a high point. Well, we don't know for sure that in near future the price would drop, would correct to give us a high point. But obviously now the price, the high point is becoming higher and higher. Even the price go up in future, right? So means still the high point is higher than the previous high. So for the price, definitely keeping hitting new highs, right? But for our deviation expert, we can see very clearly the high points lower and lower, right? So this is lower and lower. Here, this is actually this part we see lower and lower. Here also lower and lower, right? Slightly. And ever since this yellow Tai Chi signal here, right? So it's more obvious. The divergence is more obvious. Generally speaking, for a very long time, ever since September last year, US market NASDAQ has been in bearish divergence for a long time, but it didn't really drop, right? So this tells us the bearish divergence, it is danger alert signal. It doesn't mean that after the divergence, the price must drop immediately, greatly. But sooner or later, the great drop would come because this is abnormal situation. Bearish divergence tell you it's abnormal situation, and the longer the divergence lasts, the stronger or forceful the correction would be in future. So is it possible that the big correction would come? So how do we know about that? Whether or not the big correction would come in near future. So to do some prediction for the future resistance levels, right? So we have several methods. Maybe you're thinking about chip distribution, right? But chip distribution is not applicable when the price keep hitting new highs, right? So the other indicator which can help us predict the future resistance level would be, you know the answer? Yeah, I think some of you know the answer. Okay, so it is extended golden section, right? So extended golden section. Okay, so if I put the cursor at put the mouse at a low point here back in September, okay, then I drag to the previous high early September, okay. So then what we see is currently the price is around which level? 161.8%. This level, actually it is regarded a significant resistance level. So we see the price hit a new high the day before yesterday, right? But last night, we see the price drop a bit. The upward momentum seems turn a bit weak, slightly weak, and now the price is around 161.8% level, right? So here we still need to be quite vigilant. Why? Because if in near future the price continue dropping, means the resistance here is very strong. Price cannot break up the resistance here, and considering we already have the bearish divergence lasted for a very long time, so if the correction, let's say, drop below the 138.2% of the extended golden section here, which is very close to the previous yellow Tai Chi, right? So means what? This would be a serious correction. So we need to get prepared that we have such a possibility, right? If the price in near future it drop firstly, the first bearish sign is the price drop below the 138.2%. If the price drop below that level, means we already get quite a high probability that this would be a significant correction here, right? And if the price can even continue dropping further to below the low price of the yellow Tai Chi signal here, then definitely this would be a significant correction. Means the significant correction after the bearish divergence is this time. But we don't need to worry so much, because now we're not sure whether or not the price would drop to the 138.2% level, right? If the level can hold, or the price never drop to touch the 138.2%, rather the price can continue going up to completely break up the 161.8% resistance level here, means the rally would run further before the big correction, the significant correction. But even that happens, the price can keep hitting new highs in near future. Sooner or later, the big correction still would come. And the higher position we are in future, maybe the more significant or the more forceful the correction would be in future. So if let me choose, okay, so I'd prefer the correction, the big correction come now, the significant big correction come now, because if the big correction come now after the correction, then we may find some other other opportunities to buy again, because if the price very high, then no chance to buy, right? So only after big corrections, then the position would be low enough for us to buy again, right? Yes, but The market would not, let's say, would not always move in our favor, right? Or it would not follow our own willingnesses. We still need to see objectively how the market would move, right? So it will not move following our willings, okay? So the important levels to check, I already told you, right? So the extended golden section, 138.2%, this level to see whether or not the price can hold if there is a correction in the future. And then the other thing is if the price never touch the 138.2%, rather continue going up, break up the 161.8, means the rally would last for a longer time. But we need to know, bear in mind the potential danger here, the bearish divergence here. Okay, so this is for Nasdaq. If you check S&P 500 roughly, would tell you the same story, right? So the price, the high point also is becoming higher and higher, but here we see the high point become lower and lower. But for S&P 500, the divergence not yet completed because we don't yet have a green bar for deviation expert, right? Only when we have green bar and the green bar continue, then we are confirmed there is another high point. We connect the highs to see whether or not we have a divergence, right? And also for the price here, currently it's not sure, it's not for sure that this would be a high, right? It's not yet confirmed. But we have this kind of potentiality or probability that here would maybe it would be a high point, because if we check the extended golden section again, maybe I choose this low. You see, it's around 100, actually also 161.8%, because it's very high. You cannot see it very clearly, right? But it's around 161.8% level also. Or if you choose this low point here, choose this low. Okay, so if you drag from this low to this high, so now the price is around 138.2%, also means significant resistance, right? Okay, so this is for S&P 500. Then for Dow Jones. Dow Jones also now is a potential bearish divergence, but not yet completed. If we check the three indexes, Nasdaq is the most let's say the most obvious one to show us the bearish divergence, right? And Dow Jones is the least, because the rally for Dow Jones is not as much as Nasdaq. Nasdaq is the most bullish one, right? Recently, yes. So if we check extended golden section, this low to this high, also roughly, or if you want to try this low and this high, yes, it should be roughly around 161.8%, the current price. Okay, so if Nasdaq drop, because we know the indexes of the same market will verify each other, right? Nasdaq drop, then maybe Dow Jones and S&P 500 would follow in future, right? So everything depends. It's not certain. Currently, it's not certain. We know the possibility here. We have the possibility here. This might be the resistance level. If the price unable to really break up, might drop. But how forceful the correction can be, not sure. Yes, on the other hand, we have the divergence. Yeah, okay. So this is for the U.S. market. If you feel worried about the potential dangers here, maybe you can consider decrease position, or maybe if you haven't yet bought any stock, you can wait for some longer time before you really buy. Currently, for me, U.S. market, my position is 0. I already sold away my stocks previously bought. So now I'm still looking, observing the market performance, the indexes, because currently I see some uncertainties. I feel that I would not enter the market immediately. I want to wait until everything become clear, the direction become clear again. Maybe I will try to find some good stocks to trade again for US market. Okay, so this is for US. Then for our STI, STI has been quite strong, right? Quite strong this new year. Ever since this new year, the performance is even stronger than the US, right? Okay, so for our STI, if we want to check the bigger picture, I switch to the weekly chart. Okay, I switch to the weekly chart, and I want to check chip distribution, because for our STI, we're not hitting historical new highs, so we have some previous highs in the history, so we can apply chip distribution. All right, so if we check chip distribution, currently we're here, right? And you see the reason why after the price break up this level here, the rally is very forceful. The first week this month, right? So this is a weekly chart. This candle is January the 8th. That is a Friday, right? So it's the first week in January. It's very forceful, right? Rally. Why? Because the space between this bar and this bar is empty, right? This is empty space here. No resistance. That's the reason why our STI can be so strong this week, okay, this past week. And we see clearly when the price, let's say, continue rising to touch this level around 3,100, there would be some sort of strong resistance. But this is not the strongest. The strongest resistance above, around this range, right? These two ranges very close to each other, right? This would be the resistance area here from the top of this longest blue bar and the bottom of this relatively long blue bar here, 3,100 and 3,230 something. So this range here would be significant resistance levels for our STI. Means when the price reaches this area, the rally may not be so forceful as this week. Okay, so we need to get prepared for that. Okay, because for this week, I believe a lot of Homely members who trade Singapore market has made a lot of profits, quite handsome profit, including myself. This week, my profit also not bad, because the market is very strong, right? If you pick the right stock, it's easy to make profit, right? But if the index enter the strong resistance area here, be careful. It may not be that easy to make profit. It's not like you buy any stock, you can make profit easily. Now the situation is maybe you buy any stock, unless the stock is really weak one, then high probability now you're at a profit, right? But when the market become less strong, you still want to make profit, you need to pick the right stock. It will be more difficult to make profit. Okay. Yes, that's about our STI, the future resistance level here. And then if we continue to check KOCI, for KOCI here, we see also the weekly chart. For example, chip distribution, previous high until now, Then for this period, we check the strongest resistance here, price unable to break up, right? So that level is around 1,680. That's the bottom. The top is 1,694. So means roughly 1,700. 1,700, 1,670. Okay, that's the strongest resistance, price unable to break up. So drop. Now the price is at support around the 1,610. This level I have talked about for a very long time, right? So every time I check the performance for KOCI, I talk about this level and this level, these two levels. Okay, so now the price gets support here. As long as the level can hold, maybe in future the price would challenge the strongest resistance here again. So if can break up, then we have let's say bigger rising space in future until we touch this relatively long blue bar above around 1,840 points. Okay, that's for KOCI. Then how about our Hang Seng Index? So for Hang Seng Index, we also can check the chip distribution. And if we check in the weekly chart, Hang Seng Index currently seems okay because the price managed to get support at the strongest support level 3 weeks ago. And after that, the recent 3 weeks have been quite strong, the performance, right? And now the price break up the second longest blue bar here. If the price can remain above this level, that will be a bullish signal, right? Above, of course, we see resistance. Let's say here, also relatively is a long bar. The value is around 30,319 future resistance level. So the thing is we need to check whether this resistance level here, is it an effective breakthrough? If the price unable to stand stably above this level here, means it's a false breakthrough. Maybe the price would just fluctuate between this level and this level. Also possible, right? The price might fluctuate here before it finally choose a direction again. Okay, so this is for, generally this is the market performance. Okay, so after checking about the market performance, let's switch back to the slides to learn our contents about indicator application. Okay, so first part, I want to talk about avoid the trap of indicators. Okay, so do you agree with it that the more indicators we use, the higher success rate we can get? If I ask you, maybe most of you would say, well, no, right? Maybe, do you agree? You can write in the chat room. I believe most of you would say, no, you don't believe that the more indicators we use, the higher success rate we can get. Okay, so this is a very rational answer here, right? But the truth is, the truth is what we really do in when we use the indicators, the Homilychart software, right? We always want to learn more indicators. Especially, let's say when recently I do a lot of one-to-one learning with new members, just newly joined Homilychart, right? I do the one-to-one learning to quickly get them lay a solid foundation for the basics. Then I always hear them say, Well, teacher Amy, so how to use this dynamic chips, how to use this chip distribution, how to use time black hole Tai Chi signal. Someone even asked me about golden section, extended golden section. Okay, you know, these are very new members. They don't even know very clearly about the basics of the Homely software. Then they just want to, let's say, learn those, relatively speaking, quite complicated, sophisticated indicators. Then I always tell them, you know, we should do the right thing at the right timing. So currently, as a new member who don't know much about the Homely software, you better learn the basic first. It's not the stage you pursue the very sophisticated indicators. You pursue to master very sophisticated indicators, then you spend the energy, right? You to learn those indicators, but you forget about the basic. So without the basic, then actually you just want to learn the in the more difficult parts. It's easily to fail, you know, and you might be get frustrated, because I always tell new members there is a regularity which can be applied for any field, for any industry. This regularity is you only have to spend 20% of your energy to master 80% of the knowledge and skills of this field. But the rest 20% of knowledge and skills, you have to spend 80% of your energy to master. So knowing this regularity, it's very clear that as new member, as a beginner, what we should do is to spend 20% of energy to master the 80% of knowledge and skills, rather than spend 80% energy to master the 20% difficult parts. Then we miss the basic, which may be more important, especially for new members, right? Okay, and then the answer, of course, is not the more indicators we use, the higher success rate we get. But you know, some people still think that the more indicators we use, the higher success rate we get. So some people, because they believe this, then they feel worried and distressed, even frightened when they realize that Homely software has so many indicators, special Homely indicators, and also some ordinary traditional indicators. So they might even get frightened by so many indicators. And then for some people, maybe they are not frightened, but they bury themselves into the sea of indicators until they get lost. Because sometimes the more indicators you use, let's say the more information you need to process, right? You need to process more information, and sometimes the information might be contradictory to each other. Indicators might give you contradictory indications. This indicator tells you to buy, the other indicator tells you to sell. Then you are totally lost. Okay, then for some people, if they continue to bury themselves into the indicators, right? So they cannot get out of this labyrinth of indicators. They begin to question, is it really useful? The indicators, do they really work? Then they become suspicious about the indicators, any indicator, including Homely indicator. And then finally they become skeptics. They don't believe that indicators work, and they don't believe that we can make profit in the stock market. They feel that stock investment is the same thing as gambling. But the truth is, is not the same. Stock investment is not the same as gambling, right? And for those people who totally deny the use of the function of indicators, or who totally denies technical analysis, right? So they have permanently become losers in the stock market. No chance for them to make profit in the stock market. So I don't want to see any of Homily member enter the third stage to become the skeptics of technical analysis or indicators. So in order to avoid, let's say, to fall into the trap of these indicators application, so I need you to know the right approach to deal with indicators, okay? So the right approach to deal with indicators. Firstly, you need to know the basic model for indicator combination. Okay, so this is trend plus fund, right? So this model is very useful because sometimes you attend a lot of different teachers' seminars, right? This session, John teach you Rainbow plus multicolor dragon. Next session, Linda teach you trend expert plus banker energy. And the next session, Robert teach you homely position, then plus maybe deviation expert or AOSF. Then you totally get confused. So which template, which combination I use, or which indicators can I combine? Can I combine homely position with, let's say, homely rainbow? Can I combine homely position with deviation expert? Then you get lost. That's because you don't know the basic model for indicator combination. So the model is one, at least you need one trend indicator plus one fund indicator. Okay, so this combination here, if you check the classical combinations we have mentioned frequently, for example, homely rainbow plus multicolor dragon, right? So homely rainbow, that is the trend indicator. Multicolor dragon, that is the fund indicator. So basic model, trend plus fund. Of course, based on this model, you can add one or two indicator as confirmation. For example, you can add a red and green signal, right? Red and green signal, which would be the trend and fund template, right? So let me switch to the software. Okay, so I switch back to the daily chart. I remove the chip distribution, change to any stock. Apple, for example. Okay, so if you click the template here, right? So fan trend template, right? I just click. Then you automatically get this combination of homely rainbow, multicolor dragon, and what is this? This is the red and green signal. Okay, so the necessary components of this combination is homely rainbow and multicolor dragon. This red and green signal here is optional. It's not a necessary one. It's just one indicator that we added to confirm the buy and sell points. Okay, and okay, so this is for this trend and fund template, right? And then if you continue to check double sort, right? So double sort, actually, this combination of indicator include three indicators. One is trend indicator, The other is deviation expert, and this is an extra indicator called AOSF, right? Okay, so if you check the basic model here, trend expert is the trend indicator. Deviation expert is the fund indicator. How about AOSF? Here, AOSF is also the fund indicator. So what's the purpose of checking another fund indicator? The function is confirmation. You can use AOSF to confirm deviation expert. Okay, so the logic here is usually the fund indicator is used to confirm the trend indicator. Okay, so fund is to confirm trend, all right? And then another third fund indicator is to confirm the previous fund indicator. Okay, it's one confirm the other, one confirm the other. Okay, but the basic should be TE and DE. This is the necessary components of this combination, and AOSF is optional because it's the confirmation of the deviation expert. Okay, so that's why for new members, when we teach them double sort, we only teach them TE and DE. We will not talk about AOSF because the more indicators we teach you, then the more easily you get confused, right? We only teach you the necessary parts, TE and DE, which are necessary components, but AOSF, even if you don't check it, still the model can work very well. This one just some confirmation. That's all. And then if you continue to check the other template here called Homilychart, right? For Homilychart, it includes also three indicators here, which would be the red and white circle, strong signal here, right? Strong signal and banker energy. And then if you check the model here, we can see red and white circle. This is the trend indicator. Only that is for short term, right? Short term trend indicator, but it's still the trend indicator. And then banker energy, this is the fund indicator, still trend plus fund. Then how about strong signal? Strong signal is another, let's say, we can say it's a trend indicator. Actually, the theory basis also based on trend. You can also say this is a signal indicator, give you buy and sell signal because the indicator is called strong signal, right? So strong signal is to confirm red and white circle. Also, the function is double confirmation. So the basic model still is trend plus fund. Then you add a third indicator as double confirmation. This third indicator can either be a trend indicator or signal indicator or another fund indicator. So if I switch back to the fund and trend, you see the red and green signal, right? Can you see the candles in the first window are colored for a certain period as red all the time, right? Then for a certain period, green. This is a red and green signal. Okay, so this indicator is let's say, also you can see this is trend indicator, or you can see this is a signal indicator. Give you the medium-term buy and sell signal. This is the function for red and green signal. Yes, buy and sell for medium term, right? So the function here is double confirmation. The basic model still is the rainbow and multi-color dragon. Okay, so if you understand the basic model for indicator combinations, then in future, you can even combine indicators yourself. You will know how to combine in a proper way. For example, if I ask you, homely rainbow and homely position. Can we combine? Can we combine homely rainbow with homely position like this? It may not be a very good combination here. And actually, I previously saw some members. They put rainbow and position in the same chart. Looks like this. It seems like a total mess. I cannot, personally for me, I cannot make a very clear analysis here. But you see some members, they still combine like this. Why we don't combine like this? Because all these two indicators are trend indicators. So you check two trend indicators here, and because both have many components here, then the chart becomes quite messy, right? Then you cannot see the performance of the price movement very clearly. So how can you do the analysis here? Personally, for me, I don't like, the combination like this. So for me, because the other thing is, these two trend indicators, the functions replaceable for each other because they are all trend indicators. Means actually rainbow can already, the effect would be roughly the same as the homely position. Of course, there would be some slight differences between the two, but roughly speaking, the functions would be the same. Okay, so this would not be a very good combination of indicators, would not be a very good choice to combine, okay? Yes, this is about the basic model for indicator combination. And the principle to use indicator combinations is, if you can use one model to solve the problems, you don't have to check another model. Or if you can solve the problem with 2 or 3 indicators, you don't need to check a 4th indicator. This is a principle here. I also know some members, especially some old members who have joined Homely for a long time, right? So before they make a decision to buy or sell for a stock, they would check all the indicators that he know before he make a decision. And usually in the end, they are confused. They don't really know what to do. Yes, because we don't need to check so many indicators. Okay, so let me switch back to the slide. Okay, so the first keynote about right approach to indicator, basic model, right? And if 2 or 3 indicators are good enough to solve the problems, no need to check a 4th indicator, okay? And the second keynote is proficiency in 1 or 2 combinations of indicators. It is far more important than superficially knowing a lot of indicators. And here, proficiency, it means that you understand the essence, advantages, and disadvantages of the indicator so that you know where to apply it. What situation is the best to apply these indicators or indicator combination. So only if you can really know where to apply the indicator, when is the best situation to apply the indicator, then we can say you really understand or you are really proficient in this indicator. Okay. Of course, no indicator is perfect and almighty. Means each combination of indicator, it has its own disadvantage also. So this is the purpose for us to learn new indicators. The purpose to learn new indicators is to make up for the blind spot of our current trading system. So maybe you use Homely Rainbow and Multicolor Dragon as your basic or your main indicator template, right? You use this template to analyze all of your stocks. And then finally, you will realize that this combination has its own blind spot. Of course, this combination is very useful, let's say for 80% of all the situations. But for the rest of the 20%, maybe that's the blind spot, right? Then you can try to find some other indicators to make up for such blind spots. Okay, so this is the right approach to apply the indicators, not only the normal ordinary indicators like KDJ, RSI, or MACD, but also the special homely indicators. Homely indicators, special ones, we have a lot. So if you know the right approach to apply them, then you will not be confused in future. And you will avoid a lot of detours in future. And okay, so now the purpose of today's session. Firstly, we need to understand deeper about the technical analysis after learning how indicators work. This is the first purpose of today's session, understanding deeper about technical analysis. And the second purpose for today's session is to shed some light on the right direction of studying any indicator in future. So especially for those researchaholics, some members, they really keen on studying and learning the skills and new indicators. But you need to have the right direction. If your direction is wrong, then just what I have said, you need to take a lot of detours. So after learning today's session, I hope to shed some light on the right direction of learning any indicator in future for you, okay? Okay, so in order to help you, let's say, in order to lead you into the right direction to apply indicators, you need to know the key to indicator application. Okay, so firstly, you need to know indicators have different categories. So just now I mentioned the basic model for indicator combination is trend plus fund, right? So you need to be able to categorize an indicator. I give you an indicator, for example, Homely Rainbow. You need to know this is a trend indicator. I give you moving average. You need to know this is trend indicator. I give you CCI. You also need to know this is a trend indicator. So you need to be able to categorize any indicator giving you in future. Okay. So the pyramid of indicators, we have several categories, different categories of indicators. The cornerstone here is the trend indicators. So according to Dawes theory, we know trend is the, let's say, the core of technical analysis, we can say. Trend is the most important thing, right? So trend indicators, they are the cornerstone. Then apart from trend indicators, we have the fund indicators. So trend plus fund, these two, they are the basic and they are the 80%, which you only have to spend 20% of energy to master, but you can solve 80% of all your trading problems. Okay, so these two are the most important. They are the basic, they are the foundation here. And if we see the trend indicators, they are the cornerstone, and then the fund indicators, you can regard them as a window. Why I say it's a window, because through the fund indicators, you will be able to know why the price is so bullish, why the price is so bearish, why there is danger here, why there is danger lurking there, or why there is opportunities, potential opportunities around the corner. By checking the fund indicators, you can know. For example, we have learned multicolor dragon, right? So for multicolor dragon, we always say, by checking multicolor dragon, you will know the big boys, how much big boys there, how much retailers there. Then we know the reason the price can be so bullish. That's because we have a lot of big boys, let's say more than 50 or 75%, quite stably for a while. These are stocks controlled or fully controlled by the big boys. And it explains why the price is so bullish. You check the bullish stocks, the EV stocks, right? And also Singapore, we have, let's say the nanofilm, all those very strong stocks. So why they're so strong? Reason lies in multicolor dragon. You check the big boys, right? So this, yes, the fund indicators, they are acting as the window. Through this window, you can see clearly the reason behind the price movement, okay? And then apart from the basic, the foundation, trend plus fund, we have probability indicators. So probability indicators, they are like the thermometer. So a thermometer is to tell us the temperature, right? It tells us the temperature of the market, whether or not the market is overbought or is oversold. If the market is overbought, we say it's too hot. The rally is too bullish. Every people become so crazy. The enthusiasm is too, let's say, too high, right? So then it's overheated. It's overheated. And then if the price dropped a lot and it's quite bearish, then oversold, right? So oversold, then it's under, the market is very cold. The emotion is very, let's say, frustrated, right? And then by checking the probability indicators, we can know the temperature of the market. It's overbought or it's oversold. It's overheated or not, okay? And then apart from the probability indicators, we have prediction indicators. So later we also will talk about some details about these different categories. How do we know, or how do we judge this indicator is a trend indicator, fund indicator, probability indicator, or indicator to do prediction? So I say prediction indicators, they are like the diamond on the top of the pyramid. We know the diamonds, usually they are very precious, they are attractive, but they are on the top, not easy to get them. So application of the prediction indicators is, it is difficult. It's not that easy to really master the prediction indicators. For example, the golden section, the Fibonacci time zone, the fifth time zone, right? So these indicators to do prediction, right? Not easy to master them. So they are on the top, not easy to reach, okay? And actually, they are not the most important thing, right? The most important would be the foundation at the bottom, okay? This is the pyramid of indicators. And then we check some details about these different categories of indicators. Usually for trend indicators, okay, for trend indicators, they are all related with moving average. For example, we have EMA, right? We have MACD. MACD also is the trend indicator because it checks the relationship between different moving averages, different terms of moving averages. Last session, we learned moving average. We know if we set the parameter differently, then the moving average can be different either for short term, for medium term, or for long term, right? So MACD is to check, yes, different moving averages of different parameter. Some longer term and some shorter term, then you check the relation between these moving averages. That's how you get the MACD, right? Okay, so related with moving average in one word. And then BIAS, BIAS also is related with the moving average. CCI, DMI, and also Bollinger Band, right? BOLL, Bollinger Band. All these indicators related with moving average, even including our Homilychart rainbow. Rainbow also is based on moving average. So of course it's a trend indicator. Okay, so then that's how you can tell whether the indicator is a trend indicator or not. And then for fund indicators, they are all related with volume. So we have OBV, VR, WVAD. All these indicators, they are related or based on volume. Even our multi-color dragon, which check the big boys, the retailers and the speculators, also related with volume. But it's totally different than volume. It's far more than volume. But still, the original data is volume. That's for sure. Okay. Then for probability indicators, usually the probability indicators, they're related with the relationship between the open price, the close price, and high and low price over a certain period. For example, we have KDJ, we have RSI, WRPSY, ARBR. All these indicators, they are studying the relationship between the 4 prices of a trading day over a certain period. Okay, and then for prediction indicators, they can do some prediction for time and space, find the turning point in terms of time and space. So we have Fibonacci, right? We have the Gann line, we have time window. Also, the wave theory can do some prediction, right? But wave theory is not an indicator. This is a theory, right? But this theory can do some prediction. Okay, so these are the main categories for indicators. If you check most of the indicators, they would be belong to one of these 4 categories. These 4 categories can cover most of the indicators. Okay, and these are the features of different category. Okay, and also some examples of each category. Okay, and also the other thing about indicators you need to know is original data. So original data means what? Means whatever indicator it is, the original, the material, the raw material would be these 5 elements. It's quite simple. It's just the open price, the close price, high and low price, and the volume. These 5 elements are the raw material for any indicator. We know that moving average, that is based on close price, right? But it's the close price for a certain period. And last session, we learned about how the moving average is calculated, right? Then you know clearly it's about close price. And then for some other indicators, let's say today we're going to learn KDJ, right? So KDJ is just to check the close price and the high price and the low price for a certain period. The relationship between the current close price and the distance between the high and the low price for a certain period. Okay, so that's the theory basis for KDJ. Later, we also will talk about the details about KDJ, just to show you an example how to, let's see, how to understand or how to understand an indicator. Not only KDJ. In future, anyone give you any new indicator, maybe you can ask him how the indicator is calculated. If you know how it is calculated, then you will know what kind of indicator it is. Okay, so the raw material, of course, would be these five. Whatever indicator it is a trend, fan, probability, or prediction indicator based on these five elements, because these are their original data. Okay, and then also we have some general principles for indicator application, right? What principles we have? Firstly, about deviation. Deviation is the same thing as divergence, right? Deviation, divergence, the same thing. And if you have learned deviation expert, then you have know the bullish divergence, bearish divergence. So here it is put as a bottom deviation and top deviation, right? But it's the same thing. Bottom deviation means bullish divergence. Top deviation means the bearish divergence. Not only deviation expert, you can check the divergence, but also some other indicators. For example, today we learn KDJ. KDJ also you can apply the divergence concept. This method divergence also applicable for KDJ. So this is the principle that can be applied for many indicators, not only deviation expert. Okay, MACD, the trend indicator, right? Also, you can check the divergence. So divergence is one principle for indicator application. Okay, second general principle for indicator application, intersection. So last session, when we learned about the moving average, we have learned the golden section and golden cross and dead cross, right? Golden cross and dead cross of moving average. Not only applicable for moving average, but also for KDJ. KDJ, we also have the golden cross. We also have the dead cross. And this intersection concept applicable for many indicators. Other indicators also can apply. Okay, and then the third general principle for indicator application is you can evaluate or check the position. If it is at a high position, that's overbought. If it is at a low position, oversold, right? So this concept here usually more applicable for the probability indicators. For probability indicators, the main function is to check whether or not it's overbought or oversold. Okay, so this is the third principle, position. And the other principle, fourth one, is turning. We have a turn upward, turn downward. For example, Bollinger Band, right? So BOLL. Bollinger Band, we always check the, let's say, the upper channel line turn upward, the lower channel line turn downward. We get a microphone pattern, right? And also for moving average, you can set some condition. The moving average turn upward, right? Moving average turn upward. Also can check. This is a fourth principle. And the last one, you need to know that for many indicators, the sideways area is the blind spot. Many indicators are useless in the sideways area, especially the trend indicators. Trend indicators, almost all of them are not applicable in the sideways area. But some probability indicators, okay? If this is a wide range of sideways, the probability indicators applicable, very useful. And later we talk about KDJ. I will talk about more details, okay? Okay, so yes, let's check KDJ, right? So for KDJ, we need to know, this is what KDJ looks like, right? So KDJ in the Homilychart software, later I will show you how to call it out. Now we check what it looks like first. The red line here, this is the K, because the indicator called KDJ, right? KDJ means are the names for the three lines here. The red line is the K. You can check the K here. The parameter is 14, right? Later we also will talk about the parameter here. So now I'm showing you the parameter 14. So K, this is the red line K, and the yellow line is D. K, D, the white line J. How are these three lines drawn, or how are the values calculated for the K, D, and J? So the formula, the equation behind the indicator here. Okay, firstly, KDJ, also we call it stochastic oscillator, right? When you say stochastic oscillator, it means KDJ. So what is this indicator? It studies the relationship between the current close price and the high and the low price within a certain time frame. The purpose is to indicate how high or how low the current position is, or put in another way, the probability that the price is at the top or at the bottom. Okay, so this is the definition for KDJ. And how is KDJ calculated? This is the equation here. So let's check X here, right? X is the constant time frame set as the parameter. Just now I show you the KDJ. You check the value in the bracket, that is 14, right? So K here, the bracket here, it tell you it's 14, right? So actually this means X here is 14. 14. So taking 14 as the parameter, as an example, if we check here, if X means 14, right? Then C14 means what? The close price for the 14th candle. Close price for the 14th candle, then minus the low price for the last 14 days. The low price during the last 14 days. The current close price, which is the 14th day, right? The 14th day's close price minus the low price in the last 14 days. This is the for the numerator here, right? And then for the denominator here, which is the high price for the last 14 days minus the low price for the last 14 days. In the last 14 days, the high price minus the low price. For that 14 days, we find the high price, we find the low price, then we minus, okay? And then times 100%. This is how we get a value for K. If the parameter is X is 14 means we check 14 days. And same as moving average is moving all the time. So every time we, for example, the value for the 15th day, it should be the close price of the 15th day, right? So minus the low price still in the past 14 day, but only that we add the 15th day, but we drop the first day. Still, the constant time frame is 14, right? So just like moving average, every time we calculate the value for a new day, we drop the oldest day, the value for the oldest day, and we add the value for the latest day. Also, it keeps moving, right? So this is how we get the value for K. After we calculate all the values for K, we connect them together, the line, the K line. The K line consists of a lot of values calculated based on this equation. Okay, so D actually is based on K. D is 3 times K, 3 times K. So if you get a value for K, then you naturally get a value for D and J. And J is 3 equals to 3K minus 2D. Okay, so this is how we calculate the values for KDJ, right? Okay, so this is the basic about KDJ. And to share with some details, J line is the fastest. Is the fastest. Okay, it's the fastest. Okay, J line is the fastest, and D is the slowest. Okay, it's the slowest. It's the slowest. And J line indicates the relation between K and D. J is the fastest, okay? And K and D, it has a range. The range for K and D is within 0 and 100. And 50 is the level that decides whether the price is in strong area or in weak area. If I go back to the, yes, for this, okay. Then you check on the left side, we have value here, right? So for K and D, the range is fixed, just between 0 and 100. But this is for K and D. For J, the value can be minus, let's say minus 20 or even lower. It can be a negative value for J. And J also can be 120, can be more than 100. That is only for J. But for K and D, the range is between 0 and 100%. And 50, can you see 50 is here, right? So means if K and D below 50, means the price is in the weak area. Upward momentum is not that strong, it's weaker. And if the price it's not price, it's K and D. The red line and the yellow line means K and D, right? If these two lines above 50 means it's strong, it's in a strong area, means the upward momentum still quite strong. So 50 is the level to tell whether or not the price is in a strong area or it's in a weak area. Okay, so then for KDJ, we have some popular parameter for K, because we just after checking the equations for how KDJ calculated, we know that K is the key, right? It's the key because all D and J are calculated based on the value for K. So how we set the parameter for K decides how, let's say, how sensitive the KDJ can be. If the parameter you set is a small value, let's say 6, then it will be quite sensitive. The smaller the parameter you set, the more sensitive and less stable of KDJ. If you take a bigger parameter, 20, you set the value for K as 20, then it will be more stable. Of course, more stable means it would be slower, less sensitive to the price changes, right? And this is for the parameter, which is very important for KDJ. And about the sensitivity, because J is the fastest, right? So it will be the most sensitive to the price movement, and D is the slowest, so it will be the least sensitive. And stability would be the opposite, right? J is the most sensitive, means it's the least stable, and D is the most stable because it's least sensitive, right? So that's about it. Then the question is in the Homely software, right? So how do we set the parameter for KDJ? Because we know the parameter is very important. So how to set? Let me switch to the software. Okay, so I changed the second window to KDJ. Okay, so if you check currently KDJ in my software, can you see, you can see the software, right? I have switched to the software. Oh, you can see the software. That's very good. Okay, so yes, for KDJ, can you see currently the K in the bracket, the value is 14, right? So means currently for my software, the KDJ value for K, the parameter for K is 14, but you can change that. The default in the software is 9 days. If I go to the setting, okay, I go to the setting, then on the right side, I try to find KDJ here, right? On the right side, I double click. Then you will see, I will try to do it again. I go to the setting, right? Then on the right side, if I double click KDJ, you will see KDJ appear in the middle here. Firstly, when you open, it's some other indicators, right? So do it again. If you check now, the default setting is in the middle, some other indicator here, TL setting. TL, I also don't know what TL is. Okay, but if you double click KDJ on the right side, double click, then yes, no need to double click, you just click, it will appear, right? Yes, click anyone you want to change. Okay, so KDJ, I click KDJ, then KDJ appear in the second window. Then you can set the parameter for K. The default, if I click default, I click recommended, right? So you will see the value changed automatically to 9 days because the 9 days is the default setting in the Homely software. The default is 9 days. 9 days. The parameter for K is 9 days. If I click save, I click save here. I click OK. Now, if you check again, KDJ here, the value for K in the bracket changed to 9 days. But if you feel 9 days is too fast, too sensitive, give you a lot of false signals, then maybe you can consider to change the value to a bigger one for K. For example, KDJ, golden cross. Golden cross, later we will talk, but I can just tell you now, it's very simple. You check the red line. The red line is the K line, right? K line, right? If you see the red line upward cross the yellow line, that is K cross up D, right? So that is called golden cross. Now, not yet golden cross, right? Then the following day, this is a golden cross. When the red line cross up the yellow, or the K line cross up D line, this is the day we have the golden cross, right? After the golden cross, the price in short-term rally, but when you see here, the price just drop significantly for one day, very forcefully for one day. You see the red line downward cross the yellow line already. Can you see it? The red line already crossed down the yellow here, right? So this is called dead cross, right? Dead cross. But for Apple, after the dead cross, the price didn't drop. Rather, it just sat with there for 1, 2, 3 days. The first day give you a big upward gap and big rally, right? And then here we have another golden cross around the corner, not yet completed. You see, not yet really, the red line not yet break up the yellow line here. The following day, clearly break up. So this is another golden cross. But the problem is, if you want to sell based on this dead cross, actually it's a false signal. It's some noise you want to avoid, right? If you want to avoid the noise, one choice is you can set the parameter bigger for K, right? So you go to the setting again. Then KDJ, you set the value for K, for example, try 14. Click Save, click OK. Now you see the value changed already to 14, right? Okay, so now you change it to 14, but you still see the dead cross here. Only for this time, it's later than 9 days. It's just now it happened here, right? The dead cross happened on this bearish candle. For if you change the value to 14, it didn't dead cross here, but it's still dead cross here, right? So after that, the price still didn't drop. So if you feel 14 is still not so stable, maybe you can try how many? 20 days. So you continue to change the value for K as 20. Save. Okay. How about this time? So either way, you have to sell here. You have to sell here, right? So this is for KDJ. So it may give you a lot of false signals. Why? Why KDJ seems not so so applicable or so powerful here for Apple? There is a reason, because this is the unilateral rise market. So later we will talk about when is the best situation to apply KDJ. You will understand why there is false signal here. Okay, but now I'm showing you the parameter for K. The bigger the parameter, the more stable, but the slower the indicator, right? Okay, so if I switch back to the slide, so these are the basics about KDJ. Okay, so for KDJ, we need to check 3 key values, which would be the most important for KDJ. What are the 3 key values? One is 20. And if you set the parameter for K as 9 days, right? So you can check 20. But if you set the parameter for K as 14, maybe you can check 25. Okay, so if K and D below 20, then means it's oversold already. If it's 14 days KDJ, right? Then you can check 25, means K and D below 25 is oversold. So 20 or 25 is the value for you to check whether or not the price is already oversold. Okay, and then the other value to check is 80 or 75. If your KDJ is 9 days KDJ, you check 80%. 80, you check 80. If K and D above 80 means it's already overbought. And if it's 14 days KDJ, then K and D above 75, we can say it's already in the overbought area. And then 50%, 50, if K and D above means the upward momentum strong, it's in a strong area, right? If K and D below 50 means it's weak. The upward momentum is weak. Okay, here you need to know that oversold, it doesn't mean that the price would go up immediately. Because we say oversold means it's already too low, the price is too low, and then there would be some rebound, right? There would be some rally. But oversold, it doesn't mean it would go up immediately. Maybe the oversold situation might last for a while before the price really go up. In the same logic, if the market is already overbought, let's say K and D above 80, already above 80, but maybe the price would just remain going up or remain sideways before the price really drop a lot. Okay, this is something you need to take notice. We can check a concrete example. Okay. Let me go to the software. We can check a concrete example. Okay, so for example, let's say Apple, right? So this is for Apple, just taking Apple as an example. So for Apple, if I switch the parameter for K back to 9 days, okay, that's the default and that's the recommended parameter. Okay, if I change it to 9 days, then we know 80% here, right? 80 is the level to tell whether or not it's overbought, right? And 80 is here. Check here. K and D above 80 ever since here, right? So ever since this candle, the price already in the overbought area, but the price keep going up before it really drop a lot, right? Yes, and this is the overbought area. Then here is the dead cross. Later we'll talk about the application of KDJ. We'll talk about the golden cross and the dead cross. And yes, this is the overbought. And then here, can you see here, the red line is already lower than 18, right? And yellow around 20. If I put the cursor on that candle, you can check the value for D is 16, for K is 11, so low, right? So yes, it's very low. K is 11 on that candle, D is 16, all below 20 means oversold, price oversold. Then after that, we see a rally here, right? And here we see the value for K roughly touched 80%, but for D still below, right? Still below. So the correction here, we still have a correction here, but not as forceful as this one. And then for here, we see K and D both didn't reach 80, right? And then at the top, at the bottom, we see for K and D, roughly around 25. I put a cursor on this candle. It show me 21. K is 21, D is 24. The low point here, K is 18, D is 22, right? Also around 20, so oversold, overbought. Okay, and then here, we see K and D also around 80, also around 80 here. And of course, for this time, it didn't drop immediately. It just keep going up. And recently, we have another dead cross, and it's around 80% oversold. Overbought area. Okay, so this is we check the overbought and oversold, and then in between we have the 50. So we see here the golden cross here. We see the price, the K and D above 50, so it's quite strong, right? So it's a strong area. The price upward momentum quite strong, and then when K and D drop below 50, around here, right? Around here, K and D drop below 50, around here, then turn weak, right? Turn weak. So 50 is the level to check whether or not the price, the upward momentum is strong. Below, K and D below means it's weak, above means it's strong. Okay, so this is about the 3 key values for KDJ. Okay, so then we can check the application of KDJ. So KDJ, firstly, we have the dead cross and golden cross, right? So usually when K cross down D, that's the dead cross. And if the dead cross happens in the overbought area, you sell, then you get a higher success rate. You get a higher success rate. And then golden cross means K cross up D. And if it happens in the oversold area, you buy, success rate also can be higher. Okay, so this is the golden cross and dead cross. We better apply them when it's in the overbought and oversold area. But there is one other thing which is very important for application of the dead cross and the golden cross, or the application of KDJ, which is KDJ is not applicable in unilateral markets. It's more applicable in the wide range sideways area. If the sideways is a narrow sideways area, you also would see KDJ, golden cross, dead cross very frequently, no use. But if the sideways area or the volatile area is a wider range, then KDJ is very accurate, actually. That's the best situation to apply KDJ. And this is extremely important, this note here, okay? Because just now I asked why for Apple, either you set the value for K as 9, as 14, or as even 20, you still have to sell. Then that's a wrong sell point based on the dead cross, right? Because that's not the best situation to apply KDJ. So for Apple, that period That's in the unilateral rise area. It's not in the sideways area. So just need to remember, KDJ not applicable in the unilateral markets. You use it in the volatile, especially wide range of volatile markets. Show you just an example. This is Singapore SGX. So, you know, the feature of SGX is extremely volatile. You can check the history for SGX for a very long time. It has been quite volatile. Either it's in medium-term to long-term uptrend or it's in medium-term to long-term downtrend. The performance is very volatile. Okay, and then if you check in the first window, I put red and white circle here. In the second window, that is KDJ, right? So if you check, for example, for this period here, it's quite volatile, right? You see the price, a lot of ups and downs, it's quite volatile. And then you check the red and white circle. For example, this is the first red circle, right? This candle is the first red circle. And if you see the first red circle, you buy the following day. For a very short term, it's already the top, already close to the top, right? So you buy based on the red and white circle may not be that good. And also here, first red circle, the following day you buy, that's the top. Okay, and for this rally, it seems like a good rally here, but the first red circle, that's a big rally. After you see the first red circle, then it's already quite high. You buy either the following day or after the third day, then the rally here also is limited. Because the biggest rally lies on the first day, the first red circle day. If you see the signal, it's already late, right? So why red and white circle is not so accurate or so useful for SGX for this period? Because we have mentioned for red and white circle, it is mostly used in the unilateral market, unilateral rise. That's the best situation to apply red and white circle. But for SGX, it's not the unilateral rise market. It's the volatile type. The rally here is the volatile rally. So generally speaking, direction still up. We see the low point become higher and higher, high point become higher and higher. For at least the medium term here, this is uptrend, no problem. But only that you apply red and white circle, it doesn't work that well. First red circle here, then the following day you buy. Also for a period, it's already very close to the top. You buy, the price will sideways, then drop, no profits. Right? So, and also for this case, first red circle, the following day or the third day you buy, profit is quite limited, right? Okay, then if red and white circle is not applicable for this kind of volatile market, then maybe you can check KDJ. Because this is the kind of situation that KDJ might work very well. Let me remove the drawings here. Then if we check KDJ, okay, so here, of course, pay attention to the overbought value 80 and also the oversold 20, right? So here, this is 16. The dotted line here, this level is 16, so close to 20, right? So this is the overbought area here, oversold area. And we see here, can you see that the red line upward crosses the yellow line in the circled area, right? So this is the golden cross. the golden cross happens in the oversold area, right? Oversold area, and when the golden cross happens, if you check red and white circle, it's still white circle, right? It's still white circle, but KDJ already told you a golden cross. If the following day you buy, you can buy 1 day to actually it's 2 days earlier than red circle, because after the golden cross here, the following day still white circle. The third day is the red circle, but we only have a chance to buy after we see the red circle. So it's 2 days earlier. And if you buy 2 days earlier, that's very important for short-term trading, for this rally here, because if you sell based on the white circle or either the dead cross here, then if your buy point is, let's say, here, then let me switch to the pen again. If you buy here, your position would be lower. Then after you see the first red circle, you buy here or here, right? Because your sell point is here. Your profit based on the first red circle is very limited. But if you buy 2 days earlier, you can catch this first red circle, big rally here, big long candle here. You can catch the long candle, and it is significant for short-term trading, right? And then next time, for example, here, this is the golden cross of the KDJ, right? Golden cross of the KDJ. And if you check the corresponding candle here, it's still white circle. Still white circle. If you buy after the golden cross, you still buy 2 days earlier, and to catch the first red circle, big candle, long bullish candle. Because the long bullish candle is the first red circle. When you see it, it's already too late. It's too late for short-term trading, right? It's already too late. And your profit would be very limited. But if you can buy earlier based on the golden cross, yes, you secure the biggest rally here for short term. And also it's the same for sell. If you sell based on the dead cross, it happens here when it's still red circle, right? It's still red circle. And next time, when you see it turn to white red circle again, right? Pay attention where the red circle, when it's a red circle, the price is still, based on KDJ, is still in the overbought area. It's very close to the overbought area. And this gold cross here, you want to buy? I don't want to buy because the golden cross happens in the overbought area. It's extremely dangerous. The market already overbought. The correction might come at any moment. I definitely would not buy at this golden cross here. So this is the value for KDJ. If it's the volatile market, it will tell you the position is high or low, whether or not it's overbought. You check red and white circle, you don't know. You don't know whether or not it's overbought. But KDJ tell you it's when it's the first red circle here, the market is already in the overbought area. Even we have a golden cross, it's not a timing to buy because the golden cross happens in the overbought area. So you will avoid buying here, right? You avoid buying here, you can avoid a sudden drop and a big correction here for short term. Then you can secure your profit here. So this is the, let's say, the advantage of KDJ. But if you want to apply KDJ, to take the most of its advantage of KDJ, you need to know when is the best situation to apply it. the best situation is a volatile market. Best situation is volatile market. And actually, this is the blind spot of a red and white circle. So means in future, if you realize that the share is the volatile type, and you know better not to apply red and white circle. But if you want to do some short-term trading, then you know KDJ maybe work better, maybe a better choice. So this is the right approach to apply indicator. You need to know the feature of the indicator. You need to know what the situation is the best to apply the indicator. Red and white circle, that's short-term unilateral market. Then KDJ, also that's short-term but volatile market, especially wide range of a volatile market. If it's narrow sideways, also doesn't work, KDJ. But if it's like this kind of volatile, then it's very applicable for KDJ. Then the other question you might ask me is, how do we know that it's volatile market, right? So how do we know it's volatile? Let me erase all the drawings. Okay, I want to continue to check the next slide. Okay, so how do we know it's a volatile market? We go back to a multicolor dragon, right? Yes, we can go back to check multicolor dragon. If you see the F chips, it's quite stably above or around 50 or even 75 for a while. This kind of stock, it belongs to the volatile type. So means if you want to do short-term trading, yes, you can try to check multicolor dragon to see, yes, sorry. If you want to know whether or not this is the volatile type, you can check multicolor dragon to know. Then if it really show you that it's the volatile type, you still want to buy low and sell high, you check multicolor, you check KDJ. You can check KDJ. So let me just show you another example. If we go to check DBS, okay? So if we go to check DBS, okay, DBS for this period. So check multicolor dragon first. What is the feature? Multicolor dragon tell you yellow bar 100% for most of the time. So this is the feature for volatile type. No red, just a big green and disappear very soon. So this is the volatile type. So for this kind of volatile type, then you want to buy and sell based on red and white circle. Your success rate for sometimes may not be that high, and your buy point can be quite slow. For example, if we go back to check for okay, so here this rally still okay. You see the first red circle is here, but KDJ, it happens 2 days early. This is the golden cross, right? This is the golden cross here already. Already we have the golden cross, but it's still white circle. So you can get prepared 1 day, 2 day, 1 day, 2 day earlier. So you buy earlier, let's say this day or the first red circle day, you can buy. But if you want to wait until you get a red circle, you buy the following day, you buy here. Your buy point would be higher. Then you buy based on the golden cross, right? But this time, this rally is still okay because it's still a forceful one. You can get some profit, even you buy and sell based on the red circle. And next time, how about? Okay, so here, golden cross, right? KDJ, golden cross here. Golden cross here. So it's earlier than this red circle. Then if you buy here, it will be better than you buy here, right? You buy lower. You buy lower for short term, especially when the rally is not a very big one. You can secure bigger profit for short-term trading. You see? And can you see the dead cross happen? This bearish candle. Can you see the dead cross? So you see that cross, you buy based on the golden cross, you sell based on the dead cross, and then it will be faster, right? It will be faster. The first white circle here, that's 2 days later than the dead cross, right? So you can buy and sell earlier based on KDJ for this kind of volatile market, then you can get a more profit in the volatile market. How about next time? Okay, so for here, a market become a bit complicated. We see golden cross, but the following day, dead cross, right? So on the third day, dead cross. So here the situation is not clear. If you buy based on the golden cross, then you need to sell based on the dead cross because the feature or the advantage is it can be faster KDJ, right? But the disadvantage is it will be sometimes it will give you more false signals than red and white circle, right? So, but if you buy and sell based on the principle, you will not lose much. But if there is opportunity, you can buy earlier. Golden cross again here. Okay, actually not very clear the golden cross here, right? It didn't really cross. Here is the obvious golden cross, right? So you buy still white circle, and this time 1 day earlier than the first red circle. Okay, so for this case, golden cross, yes, also 1 day earlier. Okay, failed. Okay. Also, because no indicator is 100 success rate, right? You know the feature of KDJ in a volatile market, it might give you earlier buy and sell signal than let's say red and white circle. But that's only applicable in the volatile market. If it's unilateral market, for example, Apple, or let's say NIO. I saw someone ask about NIO in the chat room, but you know, it's not the classes, the sessions here. We set the sessions here. The purpose is not to help you diagnose the stocks. The purpose is to let's say share with you the methods. You learn the methods. You can diagnose or analyze yourself. So I'm not diagnosing NIO here for you. I'm just taking it as an example to show you what kind of situation applicable for KDJ, what kind of situation not applicable for KDJ. Okay, so if you check NIO, Monte Carlo can tell you it's the very bullish type, right? Extremely bullish type, because most of the times big boys can be above 75% quite steadily for a while. So this is the extremely bullish type. And if you want to sell based on the dead cross, you sell the market didn't drop. It just sideways for several days and then recircle again, continue going up. You see that cross, no correction. That cross, no correction. And we see the price remain above the, around the overbought area for a long time. All the time it's at the overbought area, right? But the price just won't drop. Why? Because it's the unilateral market. It's the unilateral. I already told you, I'm not diagnosing stocks for you. Okay, stop posting stocks in the chat room. I'm teaching you the method. Okay. Okay. So yes. Then you see the price remain above or around the overbought area. But why the price just keep hitting new highs? Because yes, the share is fully controlled by the big boys. So unilateral market, KDJ not applicable. You don't want to apply KDJ when it's unilateral rise. How do you know it's unilateral rise? Multi-color dragon already told you it's unilateral rise. Okay? So yes, so this is about when is the best situation to apply KDJ, right? For golden cross and dead cross to buy and sell for short-term trading. And then let's check the other application for KDJ. Okay, the other situation to apply KDJ is bullish divergence and bearish divergence based on KDJ. And this kind of a divergence is, we check the divergence between the price and the K, just the price and the K. We focus on the K line, okay, only the K line. And we check the price for bullish divergence. We check the low point and low point for price and for K. And for bearish divergence, we check the high and high for the price and for the K. Just to show you an example. SGX again, okay, SGX again. And okay, still we can focus, still pay attention to the overbought and oversold value. 18, this is 18, this is 81, right? And then can you see that the above we have the price, the high point become higher and higher, right? So the price become higher and higher. If we check the value for K, the red line, right? So for K, this high is here, this high is here. We say it's going flat, roughly going flat, actually slightly downward or roughly flat. So this is divergence, bearish divergence. So after the bearish divergence, we got the dead cross, right? Dead cross around the or in the overbought area. So you sell here after the bearish divergence. When you have the bearish, you have the dead cross in the overbought area, your success rate can be high, right? So we get a big correction. Okay, so this is the bearish divergence. And then can you see the low point here for this low and this low? The low point from here to here, that becomes lower and lower, right? And for our KDJ, the K line here, the low point, slightly higher. So this is the bullish divergence. And then after the bullish divergence, we have the golden cross. Golden cross happens in the oversold area. So on one hand, golden cross in the oversold area, we already got the success rate higher. On the other hand, we got a bullish divergence. Then another evidence, we have opportunity. So that's why after this golden cross here, the rally is quite a forceful one, right? Okay, so after this forceful rally here, we continue to check the high point here, become higher and higher. But we check the K line, the red line here, the high point also roughly going flat. So this is another time of bearish divergence. Then after the bearish divergence, can you see here we have a dead cross? Dead cross we sell, right? Because this sell point is because the dead cross happens in the overbought area, and also it's after the bearish divergence. You sell, quite a good decision because your sell point is around here. Although after you sell, you miss the further 2-day forceful rally, right? But also you miss the very sudden big correction, right? So it's still worthwhile selling here earlier, right? Than the real high points. Okay, so after you sell here, we see actually another golden cross, but can we buy at this golden cross? Can we buy? Better not. Why? Because this golden cross happens in the overbought area. Overbought already. It's very dangerous. So we see quickly it failed. That cross again, right? So we don't want to buy here. If you check red and white circle, maybe you don't know whether or not it's overbought area. But you check KDJ, it will tell you. That's the function of KDJ. But this indicator here, it works the best in the volatile market. Actually, all the probability indicators, they work the best in the volatile markets. Most of the probability indicators, they don't work that well in the unilateral market. Okay, so I think that's roughly what I want to share with you today about indicator application. Okay, so the most important part, I believe, is the first and second part of this session. The third part about KDJ, right? So that's just an example to show you how